The way that I would describe it is the companies within climate tech, so the startups themselves that are solving a real problem for their customers and are mission critical for their customers, are continuing to grow rapidly and are continuing to get funding.
Welcome to our year-end episode of In Between Charges. I'm Kevin Spangenberg, joined as always by my co-host, Mike Hawks. Mike, how are we doing?
Very good, thanks. Very good. Yeah, getting close to Christmas, feeling Christmassy. For some reason, we decided to come matching shirts this time.
Yeah, matching shirts. Big plans for the holidays.
Going to be in Norway, actually. So the snow that's outside in Copenhagen will have nothing on. The 4 feet of snow that's going to be there. But as a Brit, I think I'm going to be falling over quite often in the cross-country skiing that happens. That's happened last year as well. Maybe I get better year by year. It's like riding a bike.
I'm going the opposite direction. I'm going to Southern California.
Okay.
No snow there.
Seafood and sunshine.
Breakfast burritos, sunshine, surf. Anyway, to wrap up this year, we have a very special guest, Mark Tomasovic from Energize Capital. Mark is a principal at Energize, as well as a board observer here at Monta, following Energize leading our Series A+ funding round back in 2022. Climate software is Energize's primary investing focus, so it is great to have Mark here to discuss some of the primary climate tech trends of the past year, what exactly is going on with EVs in the US, and then we'll take a little look ahead to what he thinks and what we think will be the major focus in 2024. Mark, welcome to the show.
Thanks for having me, guys. I had to wear my Monta sweater here to represent. I really appreciate being on the show and happy to talk all things EVs.
Yeah, really happy to have you here. The sweatshirt might be a little outdated, actually, by this point. I think that's an old coral. We're now moving to a deep coral, so we'll need to...
Oh, there we go. Okay.
That's good.
The OG, then.
But it represents that represents V1 merch, so that's good.
We'll get a new one in the post for you. We'll get a new one sent over your way. Great. So we'll start off. Mark, electrifying everything was a white paper / deck that was shared here at Monta once we learned about Energize's interest in our company a little over a year ago. And electrifying everything kind of underpins your investing approach and what led you to Monta in the first place, as we sort of sit right in the heart of charging infrastructure that is being built out to support the electrification transition. So maybe could you discuss a little bit what electrifying everything means to you and to Energize, and how that fuels your approach to investing?
Yeah. So at Energize, we have 4 core investment theses, and those are electrify everything, carbon and emissions, infrastructure resiliency, and then industrial digitization. It is one of the 4 core pillars that we invest behind, and we think that it is one of the areas which has accelerated really rapidly over the last 5 years, where there's become a demand for products like electric vehicles, solar, wind energy, battery storage, and everything that comes with kind of electrifying really your daily life.
Maybe then just to kind of follow on from that, I think, can you describe as well a little bit about, I guess, kind of how you maybe measure and evaluate companies across those theses? I mean, are you an impact capital firm? Are you also, of course, naturally looking for rates of return? There's a lot of uncertainty in the market. How do you work with that?
Sure. Well, what's unique about Energize and what was unique about our whole investment thesis is that I would say it's the first time in several decades where you can actually make an impact and make a return, and those things are not counter to each other. It's the first time where impact returns are actually becoming synonymous with capital returns. And the reason that is because a lot of the hard costs in a lot of these very impactful technologies, such as solar, wind, electric vehicles, have decreased significantly, where now they need new software technologies to scale. And so it's the first time where you don't have to make a trade-off between impact and investment return.
Yeah, I think it was it 10 or 15 years ago, they considered the first climate tech wave of investment that kind of crested, and then actually a number of those companies did not do very well, right? And then a lot of VCs kind of felt burned by that. But now, like you said, there's not a trade-off that needs to be made there, right? And I think Energize invested in the first climate tech unicorn, is that correct?
That is correct, yeah, and that would be a solar software company that we invest in.
Yeah.
And regarding what we call Climate 1.0 that you were mentioning, that was a pretty important time in the history of climate tech, because a lot of those investments were investments in material science, were investments in hardware, and a lot of those investments helped drive down the cost of batteries, helped drive down the cost of solar panels, drive down the cost of wind turbine technology. And because those costs have now been driven down, firms like Energize can invest in the digital technologies to help scale those hardware. And so now we're in the second wave, which has become a much more profitable wave, and a wave in which you can invest in the digital layer on top of those now commoditized hardware technologies to help scale those technologies.
Definitely. So maybe let's shift a little bit to talk about 2023 here, where we're in December and we're rounding off the year. A lot's happened this year, especially in the climate tech space. And some of it's been turbulent. Some of it's been really positive. And then there's other kind of negative trends that have happened as well that throw a little bit of a few flies in the ointment, let's just say. But you're in the US, the Inflation Reduction Act was passed in 2022, and we've finally seen a lot of that money be rolled out this year. What type of impact has the Inflation Reduction Act had on climate tech companies? Is it just a bonanza in the US right now? And kind of what are you seeing going on so far in 2023?
Well, it is hands down the largest bill that has ever been passed for clean energy here in the United States. And the reason for that is because it includes a lot of things like investment tax credits and production tax credits, which really contribute to the economics of these overall renewable energy projects, specifically on the utility scale side. And then it also includes a lot of things around home upgrades, labor upskilling, and kind of all of the derivative industries that are required to actually get the steel in the ground. And so it is the single most impactful bill that has been passed in the history of the United States. And we're seeing massive tailwinds. In fact, we're actually seeing funds that are being created to invest specifically because the IRA was passed.
And I think we've also started to see, a lot of that money now start to actually be applied to businesses and be separated out, obviously by states based on volume of people, number of projects that are basically ongoing there, and then how can they actually turn it into, real cash that people can use to purchase and get hardware installed on the top of homes or charge points basically in the ground. But a big trend that we see in the US, you could also say that happens in Europe as well, is a big disparity between the top 4 states, maybe if we take it in the context of EVs, Florida, Texas, California. Well, how could I forget California? And Washington, DC and state, miles ahead the rest of the states from adoption rate. So could you maybe comment a little bit on how you think it's being applied and maybe some of the reasons why some are so promising, whereas others are perhaps a little bit more lagging behind?
Yeah, a lot of what it has to do also relates to state-by-state regulation. And so there are some state-by-state regulations which have additional incentives for various businesses and for the actual consumer to adopt electric vehicles in particular. And then I would also say there is a component to basically what are the major cities within those states and how geographically dense are those cities. So it's harder to roll out EV infrastructure and gain EV adoption in certain states in kind of the middle of the country that are more rural. Whereas if you look at San Francisco or New York or certain parts of Texas, just the geographic density of those cities makes EVs a lot more attractive.
Just drawing a parallel between Europe and some of the conversations we've had, a big change like this, it really does always come down to a conversation about what subsidies are available, what kind of policies are basically being written, and then ultimately how much does it actually have an effect on an individual consumer's choice to be able to purchase something that's still affordable and isn't a massive deviation away. And I also feel like there's so far, not almost always, I think that's maybe broad, but US, California, streaks ahead. Also in Europe, there seems to always be one founding country that is really lighting the torch and really kind of holding the banner for changes like this. And the difference between those countries, where those that are perhaps more laggard, so if I compare Norway to Spain, one of the things is, yes, about the subsidies and policies, but also how early they were able to implement them. Norway's been doing this for almost 30 years, and EV cars have been on there for quite some time. And then what we also see is those regulations kind of forming the standard for the rest of, or the neighboring countries to basically adopt and kind of be picked up from there. And I feel like Florida and Texas are starting to play that.
California's done that, right? There's been about 15 or 20 states that are following California's lead in their fuel emission standards, I believe, right?
Yeah, certainly. Massachusetts being one of them. And what I will say about the United States is we kind of like to say with regard to pretty much everything electrification, Europe always feels like it's about 3 years ahead of the US. And some of the data that we use to actually drive that point home is when you look at the US and you look at like a new electrification technology, we see that once the new sales of that technology reaches 5% of new sales. So for instance, in the US, we just crossed 5% of every new vehicle purchased in the US is now an electric vehicle. I think we're now at 6 or 7%. But once you pass 5%, that adoption starts to become exponential. It's kind of an S adoption curve it's pretty applicable across certainly all electrification technologies. And several countries in Europe have already surpassed that number. I think in Norway, it's like at least over 80% of all new vehicles purchased are electric vehicles, probably even higher than that.
Yeah, exactly. I think it kind of fluctuates between 80, 90%, and also that's 80 to 90% BEVs. And then a mix of that is going to be PH as well, but a lot of them are actual real battery electric vehicles. Yeah.
But to your point, sometimes you also have to think of the US as 50 different countries, and you kind of have to look at each of these markets individually to try to really get a better hold of what's going on.
Yeah. California is not 3 years behind. California is maybe a year behind or something, right? But
right.
But
Kevin's back up there. Whoa.
I'm not even from California. My family lives there now. I'm not really from there. I'm from Washington, another state that's doing pretty well. But maybe to continue on that thread, there was a headline I read the other day, and the article was like, don't believe the headlines. The vibes are fine in the U.S. And I think the last couple of months, we've seen a fair bit of negative press in the U.S. regarding EV adoption. You see Ford dialing back their ambitions. You see GM dialing back their ambitions. You see Tesla continues to cut their prices and everything. But then you look at the numbers, and Q3 had like 60% year over year growth over Q3 of 2022. And so maybe, Mark, you can just chime in a little bit with like, are the vibes around EV, a little bit different? What's going on? Because the numbers are telling one story, but then the headlines in the Wall Street Journal and Financial Times and everything are saying a different thing. They say stagnating sales, and I'm not seeing that. So maybe you can shed a little light on that.
Yeah, it's interesting because you're not the first one that's brought that up actually to me this week, but we haven't seen that. Like when we've been in the market talking to these entrepreneurs, talking to various corporates in this space, we haven't seen the slowdown that may have been reflected in certain headlines over the last week or two. In fact, we're continuing to obviously invest in this space. We're continuing to build out our thesis around it. We think EVs are certainly here for the long haul.
Yeah. And when I think about this a little bit, I'm kind of like, these big battery factory investments that these companies are making, like, you don't really undo that. Now, you can like slow down that a little bit, but like, these are multi-billion-dollar investments that these companies are making. And that combined with consumer sentiment, plus with the tax credit becoming a $7,500 point of sale application as well, I just think the forces are still pointing in the right direction. Yeah, is it going to be a straight line up that S curve you mentioned? No, probably not. But I just still think there's a lot of tailwinds there.
Yeah. And I guess the other part, maybe, Kevin, related to what your point around how this is happening now. OEMs and other manufacturers are really reaching a tipping point where they're basically choosing new sites. They're investing in new sites. It takes a manufacturer 10 years to change their whole manufacturing line. And they're already, 1, 2, 3, 4, 5 years into that for different manufacturers. It's very hard to turn that around already. And for that to basically spin in the other direction, it's almost impossible. Maybe it is also just a little bit about manufacturers, individuals really starting to now become a little bit more realistic in what can be achieved year on year and actually what your manufacturing capacity is, particularly with some potential limitations in the supply of raw materials. Perhaps this is just a little bit of a sign of some sort of industry growing pains, right? And we're kind of getting towards a more normal cycle and routine.
Yeah, and maybe what I would add to that is, interest rates are at an all-time high, right? And the whole purpose of the Fed raising interest rates was to slow down the economy and slow down inflation. But the areas where construction in particular, and I consider installing an EV charging bank construction project similarly to installing utility scale solar, the areas where construction is continuing to persist are these areas that have a lot of federal funding and a lot of grants behind them. So it's areas that are funded by things like the CHIPS Act here in the United States, by the Infrastructure and Jobs Act. Those areas are still a very bright spot in the U.S. economy, and there's still areas where we're seeing a lot of growth.
I want to talk maybe about American CPOs for a moment, a little bit, right?
Niche.
It's on everybody's mind. In Europe, it's a pretty fragmented market, and there's, each country kind of has a few champions that are building out these big charge point operation businesses with high power charging along the highways. And these businesses are starting to actually turn a profit. They're starting to be like profitable businesses because the utilization rate is increasing over here. And you see companies like a Fastned, like an Allego, these are like, they're recording 30 million euros in a month or something in revenue, that type of thing, and they're in the black. The US, it's a little bit of a different story. ChargePoint is obviously the big public charge point operator besides Tesla, and we can talk about Tesla in a little bit. But ChargePoint's having some issues, right? Other companies, Electrify America, EVgo, are having issues. And I guess I kind of wanted your opinion on that a little bit. Is it just the economics of a charge point business right now? Are those tough to make work across the US, just given the low adoption rate, and it just takes some time and they just need more patience? Or is there something else going on?
Yeah, specifically within the US, there's a lot of demand for level 3 charging. And that's because we love our highways, but we want to be able to charge on the go. So we currently don't have the behavior set up in the US or kind of the infrastructure set up to incentivize longer term charging. But level 3 charging is very expensive. So it's, it could cost up to $1 million to install a level 3 charging bank if you have to do various transmission upgrades and install various transformers at the site. That increases basically the capital intensity of kind of these businesses that specifically focus on the hardware. We have seen ChargePoint make a few acquisitions in the space to try to get more and more involved in the software portion of charging. But what I would say is, in general, a lot of hardware, whether it's in solar or wind or now EV charging, it ultimately becomes commoditized. Adding on top of that, there's a lot of demand for the level 3, which are very capital intensive business models. It just makes it a very difficult business to scale overall. Yeah. And so we need software solutions to help deploy these hardware units at scale and kind of in a low cost way with greater distribution leverage.
Yeah.
Kind of makes me wonder, is it like you let ChargePoint or you let other companies take the hit up front to someone's got to front that cost? And is it the next wave of operator that gets to swoop in and have the asset when the utilization level is there to really make that work?
Yeah.
I don't know. Thankfully I'm not running a ChargePoint operation business.
Yeah.
But
I feel like if ChargePoint was to look back on 2023 and maybe describe their year in a few words, it would be heavily disrupted, right? Yeah. And then also perhaps they've made the move, right? So acquired has to be huge acquisition, 240 million to really kind of get the software side of things, build recurring revenue, get the whole operation part out of it. But now there are so many new entrants to the market who are really software first, and they can be much more nimble. They can also have greater experience and offerings, and then also maybe you tie into the Starbucks that someone wants to park next to you and you have like a complimentary offering there. It just makes much more sense for the owner and actual owner of that site to drive more traffic and revenue through to them. And I guess also, like you say, Allego in Europe starting to report significant profits, right? It's also a long business model for people to be able to get to that type of size and type of that state. And I think there's perhaps less demand for level 3 charging here because people will travel much less.
Yeah, well, Americans drive more, right? And like Mark said,
3 or 4 times much more.
There's a bit more of a culture over here. Like you drive to work and you're going to have an opportunity to plug in at work, right? Your employer provides that, and you're going to have it at the shopping mall, at the restaurant, at the hotel. And I think the US will get there, but it's just not there yet, right? And I think there's this expectation right now and a real focus on that level 3 charging. And it's just, okay, I need to be able to charge in 20, 30 minutes. That needs to be close to my home. And why is that not there? I'm unhappy that it's not there. But over here, there's a lot less of that. There's a different mentality.
Right. Yeah. And what we're seeing in the US is there's actually been demand for various software products that can help these charge point operators site their chargers, because like you said, utilization is the name of the game here. So if I'm better at siting based on traffic or based on utilization patterns, then I can obviously drive profitability that no one else can. So there's a lot of various AI and ML tools coming out that are focused on, okay, where do I actually put the charger if I'm a CPO?
But what I thought was so interesting in going through Fastned, they're a major Dutch CPO, and they're now throughout Europe. They were finally entered the black for H1 of 2023, and they did it when utilization rate was 11.5%. 11.5%, and they were finally in the black. That's for one half a year. But I was like, that is so much lower than I anticipated. Yeah. But I think the number might be lower. The utilization number might be lower than we anticipate to actually make this work.
Yes, it depends also on the charging type. You can have the same revenue from 10 to 15% of your DC that you would need to have from 100% of an AC charge as well, because your consumption rates are much higher. You can also add on other kind of fees to it as well. But also then maybe related to it is in Europe beforehand, it's been funding to get charge points in the ground and get them installed Now it's a focus on quality and experience and consistent and performance and safety. And perhaps then in the US, now we're seeing that shift. Let's just get charge points out there. Let's get accessibility there. Let's remove the fear that people are going to slowly roll to a slow halt on the side of the freeway and have to do one of these really kind of undramatic but very slow keels into the hard shoulder because there's no charge point nearby. Now it's about, okay, I have 99% reliability with this charge. And also I associate that with a network and with a brand. And there are more companies that are able to offer that.
Let's maybe round it off then with one
Cool.
Tesla question.
Yep.
I think, is that fine, Mark?
We cannot have a podcast without a Tesla question.
Well, but it's related to, we were just talking about American CPOs, and obviously Tesla is kind of the American CPO right now. Tesla's role in America is just very much different from the way it is in Europe. So I guess, do you see space and room beyond Tesla, right? How do you see Tesla's role evolving, in the next couple of years in terms of charging infrastructure in America?
Yeah, so short answer is yes. There's definitely space beyond Tesla. So Tesla, like you said, Tesla and ChargePoint make up the majority of the market. I think combined, those two make up almost 70% of the market. There's another 15% of the market in the US that are non-networked. And so I think these are companies that don't even have really software to operate and to especially do a lot of the features and functionality that Tesla can do, like auto charge and self-healing of the charge points and other things like that. And then the last 15% are these smaller CPOs that have their own brand. They have pretty significant scale, but it's relatively fragmented. I would say within that 15%, there's at least 7 to 10 brands. So amongst the 15% that are kind of fragmented across 7 to 10 brands, the 15% of non-network, I would say that's 30% kind of market opportunity for various folks in the space that want to sell to folks that aren't Tesla or ChargePoint.
Hopefully that 30% grows into a larger percentage, right?
Yeah, I think that also has to do with like geographic fragmentation as well, right? Because a lot of that 30% are also very geographically specific. So you'll see certain brands will evolve in various states that Tesla and ChargePoint, for whatever reason, haven't really penetrated yet. And so, yeah, like you said, I do think as more and more states themselves begin to adopt EV, that 30% should grow in market share.
I'd be interested to also understand how far does the needle shift between rolling out new charge points versus trying to maximize revenue on their existing network because their experience is so high. But fair enough, on the one side, they got ahead of the game a little bit, but at some point it's something that will be mandated and regulated. We're seeing that push basically out here as well. So I don't know if they always have a choice.
Yeah, and I'm curious how the experience will evolve when non-Tesla vehicles are there, right? And will that stay an optimal, awesome experience for everybody? Or does it become difficult because they, for a while, have not adhered to the standards that other charging operators and softwares have to deal with, right? They've kind of had their own closed loop system.
You hear stories already. They take over 2 parking spots, driven across. Some Tesla driver who's, one of the early adopters, been driving it for 10 years, says the heyday is over. Yeah. Where's this F-150 come from?
What the hell?
Absolutely, right? And I think, as the OEM brands become more fragmented, that's going to lead to, like you said, Tesla might open up their network. I think they've already done that with a few of their charge point locations. And so it's like, it's really kind of, what do you do? Do you stay Switzerland, like the ChargePoint model, or do you stay kind of a closed loop network like the Tesla model? I think eventually, as more fragmentation will push more people to kind of be Switzerland.
Yeah. All right. I think that's enough about the USA here. I'm happy to keep talking about it if you'd like to, but let's maybe, Michael, hand it back over to you.
Yeah, no, just want to change gears then a little bit. So we've talked a little bit about electric vehicle charging, Energize's role in that as well, but then also kind of broader climate tech. We touched on it. But one thing I wanted to, bring to the table, particularly thinking about 2023 and maybe also the year before that, it's been kind of quite turbulent from a VC and from a capital point of view. For example, the climate tech space itself, even in an area that has significant government funding, really high public opinion polls, there's been 40% fewer investments in the first half of 2023 than there were 2022 within the climate tech space. And then as a result, generally it's been harder for these companies to raise money, for the companies to actually go out and look for new pools of cash, and particularly because a lot of these companies are very kind of cash intensive to begin with. They need a lot of capital investment to be able to get off the ground. And I wonder, as a result, there's an opportunity there that we're kind of losing out on companies that show significant promise, but just haven't been able to get started for one reason or another.
Yeah, well, I think the first thing is you have to match the business model to the funding model. And what I mean by that is when you look back to climate tech 1.0 in the early 2000s, is there was a lot of very, very capital intensive business models that were expected to scale over 20-year horizons that were funded with venture capital, where the fund model was expecting a return within a shorter horizon. And so now, fortunately, we are seeing pools of capital that have 20, 30, 40-year fund lives that will make investments in more capital intensive technologies that will continue to fund those investments over multiple decades. And I think that funding model is really helping propel a lot of these kind of earlier breakthrough technologies to get them to where they need to be, so that when they've reached some scale, when they've kind of hit their inflection point, a VC fund can come in and kind of bring them to the next level. In addition to that, there's also a big role that private equity and infrastructure funds will play. And I think a lot of the areas that you're seeing private equity and infrastructure take place is when they buy some of these retail gas stations and they can use them and convert them into EV charging stations. And then there's also various plays on more of the highway corridor infrastructure investments that are being made out of infrastructure funds. So I would kind of segment it into maybe 3 different buckets. The first bucket I would say is traditional venture capital. That's used primarily for digital technologies that can really scale within that 12-year horizon. There's then more of the kind of the breakthrough bucket of funding, and that's a 20, 30, 40-year horizon where they're going to invest in really kind of groundbreaking material science, fusion technologies, things like that, that are much more capital intensive. And then finally, there's infrastructure and private equity, which are investing in more of the kind of recurring cash flow, more of the infrastructure itself that will generate some sort of recurring profit.
Amazing. Thank you. Yeah. I mean, could you share a little bit about what kind of companies that you're watching in this space, or those types of breakthrough companies? It'd be great if you could kind of highlight a few that really stand out for you from 2023, not just in the US, if there's also others that have come out from Europe.
Yeah, well, I mean, I would say Manta is kind of top of the list.
Definitely
there,
wasn't
right?
fishing
If you
for
look
Manta
across
there.
the whole climate ecosystem. Other things that we're seeing a lot of velocity in at the moment are things like marketplaces for electricians. Because we do have a skilled labor shortage really globally, we need folks to actually help get the steel in the ground and wire, whether it's residential solar or heat pumps or EV charging. There's a lack of electricians globally. Maybe a few other things are various other forms of home electrification products. So heat pumps in particular are beginning to have a lot of traction. And then finally, I'll say on the utility scale side, we're still seeing a lot of construction in the utility scale solar category.
And maybe if you were to sum up, Mark, 2023 from a climate tech space, what would you say? How would you describe it?
The way that I would describe it is the companies within climate tech, so the startups themselves that are solving a real problem for their customers and are mission critical for their customers, are continuing to grow rapidly and are continuing to get funding. The companies that are more discretionary, various forms of kind of not as needed, certainly not mission critical to their customers, are the ones that are really seeing the effect of interest rates and then seeing difficulty garnering fundraising in this market environment. But if you're solving a real problem for your customers like your solution, you're helping your customers grow their business, and you're mission critical to their operations, then those startups are having no problem.
Yeah, was it an Energize blog talked about getting into the meat and potatoes of various companies' software. You want to be meat and potatoes software.
You're talking about your Thanksgiving dinner?
Right.
Yeah. I'm talking about Thanksgiving, but
you want your software to actually add true value, right?
Yeah.
Show ROI quickly to your customers.
Yeah.
I think people are doing a lot of budget cuts right now, and they're reevaluating what's needed to run their organization. And if you're not needed, then it's hard. But if you are needed, then that makes you ever more important in kind of this high interest rate downturn in the market.
Yeah, I think also, and the reason why that's specific to climate tech is because when businesses are trying to transform towards meeting their CO2 footprint, meeting kind of net zero, that journey is expensive. There's not space for frills and tools that aren't really solving a core business problem. Everyone's now kind of focused on heads down, just getting this stuff in the ground and actually working and operating. There's no time for the kind of parts on the side.
Right. Yeah. And like you said, like our industries are no frills. They're folks that are actually out in the field building construction projects. They're not going to want something that increases the complexity of their day-to-day task. Like they're not going to buy things that increase the risk of kind of their construction projects getting executed. And so, yeah, they're just going to want things that work, right, and help them build their business. And the last thing that I would add is if you're helping your customer build more business or sell more charge points or sell more services or whatever it may be, then if they stop using your product, well, then their top line is going to decrease. And so always being aligned to top line is a huge advantage if you're a startup and you're building a product, because then you can say, look, before you were using Monta or before you were using X, Y, or Z software, you were doing this much in revenue. After you've adopted our technology, you've doubled your revenue or whatever it may be. And so no one's going to want to go back to cutting their revenue in half, right? They now become reliant and your product becomes kind of tied to their top line.
Okay, so then thinking ahead to 2024 and maybe thinking not just in the context of Energize Capital, but also, your own kind of market reflections of what's coming. What's on the horizon for you? What do you believe are some of the major events that will be happening in 2024 from a climate tech point of view?
Yeah, so we're certainly continuing to scale with the space. I would say the space as a whole for climate software is continuing to scale. So we've actually recently rebranded from Energize Ventures to Energize Capital because a lot of these earlier seed type companies have now evolved into Series A, Series B, Series C, and even beyond, which I think is relatively new in the market that some of these companies are now requiring growth equity. And so we want to be the ones to provide that growth equity to them. So I would say the market is going to continue to evolve, specifically climate software market. And we want to be a part of that, right? We want to help kind of continue to fund these companies all the way through IPO. And so, we're not slowing down. We want to be indexed to the market and we want to be the premier climate software investor and kind of become synonymous with the space.
If you're thinking about maybe the industry or the space or the theme that you're most excited about, and again, I'm definitely not fishing for a kind of point on Monta or kind of EV charging. What's that standout market area if you were to kind of predict what might happen in 2024?
Yeah, I think if we go back to the 4 pillars of Energize, there's the electrify everything pillar, carbon and emissions, infrastructure resiliency, and then industrial digitization. The 2 that I'm in particular most excited about are electrify everything, obviously, because of these tailwinds, because of these tax credits, because of kind of overall consumer interest in things like heat pumps and kind of electrifying their household. And then industrial digitization as well. So if you look across all of these kind of more old school markets, whether it's construction or manufacturing or various control systems, there's been quite a few breakthrough technologies in machine learning recently, which have enabled those markets to kind of scale quicker. And now we're finally seeing those markets begin to adopt technology because they're actually realizing that these things are mission critical to their business.
Very cool. Thank you, Mark. Also very excited for 2024, and we'll keep track of those that you've mentioned already.
All right, Mark. So we end every episode of our podcast with the same question. And so now I'm going to put it to you.
What is your favorite meal over Christmas?
What is your favorite Energize Capital portfolio company? No. But
you ask every company that, or every podcast host
Mark's got our jumper on.
It's weird. It doesn't. Most people don't have an answer to that question. We just keep asking it, and finally, I think we're going to get someone who can answer.
I appreciate that. No, I appreciate that.
But no. So, if you could bust one myth about electric vehicles or the electric vehicle industry, what would it be?
Yeah. So my in-laws just recently tried an electric vehicle for the first time when they rented somewhere in the Midwest. Unfortunately, when they received the vehicle from the rental car company, the vehicle had like 20% charge. They went and they used a EV charging location that was a DC fast charger. So they got it up to 80% in like 20 minutes. But unfortunately, they've continued to have the mindset of range anxiety and of I'm going to have nowhere to charge it or my route is going to be impeded. I think people don't realize that there is technology available out there like Monta to locate, to reserve, and to kind of automatically charge your vehicle really at the click of a button or the plug-in of the cord. And so the myth that I would try to dispel is the myth that range anxiety experience, if they have, for whatever reason, gotten their vehicle from the location at a 20% charge, that's not your experience if you bought an EV and if you're a regular EV driver or if you've adopted some of the technologies that exist out there in the world today. And so what I would say is there will be a bit of behavior change at the beginning when you become an EV driver, but the technology exists today to really make that experience a seamless experience. And, EVs are going to continue to persist. And so I think it's just a matter of getting on board.
My brother is trying to buy an EV, and his problem is they don't have chargers at his apartment complex in Delaware. But he's like, but there's a supercharger network at 5 minutes down the road at a Wawa. And I'm like, well, there's a solution to your problem right there. But I think there is behavioral change. It's not perfect in every country or in every state, but it's getting better and it will be better. And so people would be wise to get on board, I think.
Yeah, definitely. And it's interesting because the cars themselves, they have so much to offer. Like you've been saying, Mark, they can really kind of connect to your home. They can give you kind of the right routes to the charge points. Everything's accessible, connect to your phone. They've got charger in there, wireless charging for your phone, all these kind of gimmicks and all these kind of things. But I think, when I buy the iPhone and use that, what I realistically need it for is email, messaging, calls, and taking pictures every now and again. And the photos that I take are already pretty poor, even though the camera's amazing. And I feel like, an EV itself also just has to do the basics, get you from A to B. You have to be able to refuel your car. You have to have enough space, and it has to be safe to drive. And they are. It's there. Yeah. There's loads of other stuff that can be done. That's great, but that's not going to be for everybody.
Right. Yeah. And it's just like any technology. When you haven't used it, then you're not going to know how much better it makes your life. And so once you try out a consumer app for EV charging, or once you kind of get in the vehicle and you've adopted various technology within the vehicle, then you're going to realize, wow, like how did I live without this before then? But I think it's a matter of kind of getting people over the hump, and whether that's adoption or actually just getting them in the cars, we need to do more of that.
Absolutely.
Amazing. Great.
Well, Mark, this has been fantastic.
Yeah.
Yeah. Appreciate you guys having me.
Yeah, this has been great. I think you hit the quota of Monta mentions in the conversation that we were hoping for. I think we set the over-under at 4.5, and I think you just hit 5, so it's good. But yeah, really appreciate you joining us here for a year-end review of 2023 and a look ahead to 2024.
Yeah, thanks very much, Mark.
Awesome. Well, thanks again, guys. Thanks for having me.
Yeah, and also then have a great Christmas.
Yeah, you as well. And I guess I will see you next year.
I think that does it for In Between Chargers in 2023. Thank you so much to our listeners. Disney, Bob Iger, we love you here at In Between Charges, so don't go fuck yourself. You are more than welcome to sponsor our podcast. Everybody else, thank you so much for a year of listening. It's been fantastic. If you like the podcast, be sure to like, subscribe, follow us on LinkedIn, give us a follow on Instagram. We're on all the social medias, and we would love your support, and we look forward to 2024.